Welcome to Booxcape, your sanctuary for book lovers. Here we provide concise summaries and insightful reviews of the best books. Turn off the noise, settle in, and immerse yourself in the world of literature. Discover new favorites and explore captivating stories with Booxcape.
Today, we're diving into a timeless classic in the world of investing, The Intelligent Investor by Benjamin Graham. Often hailed as the definitive book on value investing, this masterpiece has guided countless investors towards smarter, more disciplined investment strategies. As we explore the key themes of this book, I'll share my insights and expand on Graham's wisdom with quotes and examples to help you grasp its profound lessons. The philosophy of value investing. Benjamin Graham's core philosophy revolves around value investing, which is about identifying undervalued stocks and investing in them for the long term. He states, "The intelligent investor is a realist who sells to optimists and buys from pessimists." This approach requires patience, discipline, and a keen eye for spotting opportunities where the market has mispriced a stock. In practical terms, Graham advises investors to look beyond market trends and hype, focusing instead on a company's fundamentals. For example, instead of chasing high-flying tech stocks just because they're popular, an intelligent investor would delve into a company's financial statements, understanding its true worth based on earnings, dividends, and growth potential. The margin of safety. One of the most crucial concepts Graham introduces is the margin of safety. He explains, the margin of safety is always dependent on the price paid. Essentially, this means buying securities at a significant discount to their intrinsic value to minimize risk. The margin of safety acts as a buffer against errors in judgment and market volatility. Think of it like buying a house worth $300,000 for $200,000. The $100,000 difference serves as your cushion against potential drops in property value. In investing, this approach protects you from downside risks while still offering the potential for substantial gains. Mr. Market. Graham personifies the stock market as Mr. Market, an erratic character who offers to buy or sell stocks at different prices every day. He illustrates, Mr. Market is there to serve you, not to guide you. This metaphor underscores the importance of using market fluctuations to your advantage, rather than letting them dictate your actions. For instance, if Mr. Market offers you a stock at a price far below its intrinsic value due to temporary market pessimism, that's your cue to buy. Conversely, if he offers an inflated price due to unwarranted optimism, it might be wise to sell. The key is to remain rational and not be swayed by the market's emotional swings. Defensive versus enterprising investor. Graham distinguishes between two types of investors, the defensive investor and the enterprising investor. The defensive investor prioritizes safety and aims for a passive, hands-off approach, while the enterprising investor is more active, seeking higher returns through detailed analysis and market timing. For the defensive investor, Graham recommends a balanced portfolio of high-grade bonds and diversified, high-quality stocks. He advises, the best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. On the other hand, the enterprising investor is encouraged to dedicate time and effort to research and monitor their investments closely. They might seek out undervalued stocks, special situations, or arbitrage opportunities. However, Graham warns that this approach requires significant knowledge, effort, and temperament to succeed. The importance of diversification. Graham emphasizes the importance of diversification to mitigate risk. He suggests, by diversifying sufficiently, the investor can lessen the risk of making substantial losses. Spreading investments across various asset classes, industries, and geographies helps protect against significant downturns in any single sector. For example, rather than putting all your money into tech stocks, an intelligent investor would spread their investments across technology, healthcare, consumer goods, and other sectors. This way, even if one sector performs poorly, The overall portfolio remains stable and less vulnerable to market volatility. Long-term perspective. A recurring theme in The Intelligent Investor is the value of maintaining a long-term perspective. Graham advocates for investing with a horizon of 5 years or more, allowing time for investments to mature and weather short-term market fluctuations. He advises, the individual investor should act consistently as an investor and not as a speculator. This approach discourages frequent trading based on market trends or news, which often leads to poor decision-making and unnecessary transaction costs. Instead, by focusing on long-term goals and staying patient, investors can benefit from the power of compounding and the overall growth of the market. Points worth remembering. Point 1. Value investing. Focus on buying undervalued stocks that have solid fundamentals but are priced lower than their intrinsic value. Point 2. Margin of safety. Always invest with a margin of safety to protect yourself from substantial losses. This means buying stocks at a price significantly below their calculated intrinsic value. Point 3. Mr. Market. Treat the stock market as a bipolar entity named Mr. Market, who offers you daily prices for stocks. Use his irrationality to your advantage by buying low and selling high, but don't follow his whims. Point 4. Investment versus speculation. Understand the difference between investing, long-term, based on fundamentals, and speculating, short-term, based on market movements. Avoid speculative behaviors. Point 5. Defensive versus enterprising investor. Defensive investors focus on low-risk investments, diversification, and long-term holdings. Enterprising investors seek higher returns through more active management and extensive research. Point 6. Stock selection for the defensive investor. Diversify across at least 10 to 30 stocks. Invest in large, prominent, and conservatively financed companies. Focus on companies with a long record of dividend payments. Avoid high-risk and speculative stocks. Point 7. Stock selection for the enterprising investor. Look for bargains among undervalued and overlooked stocks. Conduct thorough fundamental analysis. Be willing to invest in special situations or distressed companies with turnaround potential. Point 8. Bonds and fixed income securities. Allocate a portion of your portfolio to bonds and other fixed income securities to balance risk and ensure steady returns. Point 9. Inflation and purchasing power. Consider the impact of inflation on your investments and focus on assets that can preserve and increase purchasing power over time. Point 10. Behavioral finance. Be aware of psychological factors and biases that can affect investment decisions, such as overconfidence, herd mentality, and short-term thinking. Point 11. Dividends and earnings. Focus on companies with strong, consistent earnings and a solid history of dividend payments as indicators of financial health and stability. Point 12. Financial statement analysis. Develop skills in analyzing financial statements to assess a company's profitability, liquidity, and solvency. Point 13. Risk management. Diversify your investments and maintain a balanced portfolio to manage and mitigate risks effectively. Point 14. Long-term perspective. Adopt a long-term perspective and avoid making impulsive decisions based on short-term market fluctuations. Point 15. Economic moats. Invest in companies with durable competitive advantages or economic moats that protect them from competitors and ensure long-term profitability. By following these principles and maintaining a disciplined approach, Graham believes investors can achieve sustainable and successful investment outcomes. Final thoughts. The Intelligent Investor by Benjamin Graham is a must-read for anyone serious about building wealth through smart, disciplined investing. Its principles of value investing, margin of safety, understanding market behavior, diversification, and a long-term perspective are timeless and applicable in any market condition. Thank you for tuning in. If you're intrigued by the concepts discussed in this review, I highly recommend reading the full book. It's packed with detailed examples and deeper explanations that can truly transform your understanding of investing.
Thanks for joining us on Booxcape. If you enjoyed this book summary and review, don't forget to like, subscribe, and hit the notification bell so you never miss an update. Share your thoughts and book recommendations in the comments below. If you want to purchase a copy of the book or audiobook, check out the link in the description. Until next time, happy reading, and remember, every journey begins with a book.